Welcome to Way to Commerce. Please subscribe to Way to Commerce. Today our concept is some basic concepts. So now we are continuing from debtors. So debtors, the several persons who have to pay to the business for the goods taken or services received are called debtors. So debtors are the persons who have to pay to the business. So for goods taken or services received are called debtors. Next, fifth concept, creditors. Creditors are the several persons to whom the business has to pay. Creditors are the several persons to whom the business has to pay for the goods received or services taken are called creditors. These people are also known as suppliers. Next, sixth concept, goods. The several goods purchased by the business or produced by the business unit for resale are known as goods. So goods means several goods purchased or produced for resale are known as goods. For example, different type of cloths in a cloth shop. So cloths are the goods in a cloth shop. Next, furniture items in a furniture shop. Fans in a fan showroom, etc. are the goods. Next concept, assets. The several articles or items purchased by the business for business use and not for resale are branded as assets. So assets are the several articles or items purchased for business use and not for resale are branded as assets. The assets can be divided into two categories. So one is tangible assets and the second one is intangible assets. So first one, tangible assets. Assets which are visible and whose presence can be felt. Assets which are visible and whose presence can be felt are known as tangible assets. The tangible assets further can be bifurcated as fixed assets and current assets. So fixed assets. So assets which are fixed in character, which help the business for a long time and which cannot be converted into cash easily are called fixed assets. So fixed assets are the assets which have fixed in character, which help the business for a long time and which cannot be converted into cash easily. So which cannot be converted into cash easily are called fixed assets. For example, land and building, furniture and fittings, electrical equipments, plant and machinery, loose tools, freehold property, leasehold property, and factory or works or workshop, livestock, that means cattle, vehicles, railway sidings. These are all fixed assets. Next concept is current assets. The assets which can be converted into cash easily are known as current assets. So, which can be converted into cash easily are known as current assets. They are also called fluctuating assets or circulating assets. For example, closing stock, that means unsold goods, sundry debtors or book debts, bills receivable, investment in securities, that means for a short period, loans given to others, cash in hand, cash at bank, etc. Next, second major concept is intangible assets. So, intangible assets, assets which cannot be seen, which cannot be felt, and which have no physical existence are termed as intangible assets. Assets which cannot be seen and cannot be felt and which have no physical existence are termed as intangible assets. For example, goodwill. So, goodwill is the name and fame of the institution. Next example, patent rights. So, that means rights to produce products. Third word, copyrights. That means rights to copy on books. Next, trademarks, designs, patents, etc. are the intangible assets. Next concept is liabilities. The amounts payable by the business to the proprietor or others are called liabilities. So, liabilities are the amounts payable by the business to the proprietor or others are called liabilities. So, types of liabilities or classification of liabilities. So, first type, on the basis of creditors. So, on the basis of creditors, the liabilities can be divided as two types. So, one is internal liabilities and second one is external liabilities. So, on the basis of creditors, first one is internal liabilities and second one is external liabilities. First one, internal liabilities. The several amounts payable by the business to the proprietor are called internal liabilities. So, liable to the proprietor are called internal liabilities. So, for example, capital, reserves or profits, etc. belongs to proprietor. Second one is external liabilities. The several amounts payable by the business to persons and institutions other than the proprietor are called external liabilities. Here the liable to persons and institutions other than the proprietor are called external liabilities. For example, bank overdraft, bank loans, sundry creditors, bills payable, promissory notes payable, etc. Here, accounts receivables equal to sundry debtors and bills receivable. So, it's total amounts equal to accounts receivable. Next, accounts payables equal to sundry creditors and bills payable. Second classification, on the basis of time. So, on the basis of time, the liabilities can be divided as short-term liabilities and long-term liabilities on the basis of time. Short-term liabilities. The amounts payable by the business within 1 year are known as short-term liabilities. So, short-term means within 1 year. The amounts payable by the business within 1 year are known as short-term liabilities. These liabilities are also called current liabilities. For example, bank overdraft, sundry creditors, bills payable, etc. So, next classification, long-term liabilities. The amounts payable by the business after 1 year are called long-term liabilities. They are also called fixed liabilities. For example, capital, bank loans, and that means more than 1 year. Fixed deposits received or public deposits received, debentures, etc. are the long-term liabilities. So, next ninth concept is expenses. So, expenses are the amounts paid by the business for the benefit received from the others. So expenses are the amounts paid by the business for the benefit received from others are called expenses. For example, rent paid, salary paid, commission paid, postal charges, advertisement charges, printing and stationery, traveling charges, freight charges, wages paid, interest paid, etc. So these are all examples to expenses. Next concept, incomes. So incomes are the amounts received by the business, from others for the help and services provided to them are called incomes. For example, rent received, commission received, interest received, discount received, salaries received, apprentice premium received, etc. are the examples to the income. Next, profit. So next concept is profit. The difference between incomes and gains and expenses and losses is called profit. So profit means the difference between incomes and gains and expenses and losses is called profit. Formula, profit equal to incomes minus expenses. Okay, next, loss. The difference between expenses and losses. The difference between expenses and losses and incomes and gains is called loss. That means here the expenses and losses are lower than incomes and gains. So formula, loss equal to expenses minus incomes. That means expenses are the lower value than incomes. It results loss. So next, 13th concept is transaction. A transaction is an exchange of money or money's worth between business and another person. The other person may be proprietor or some other person or institution. So transaction means an exchange of money or money's worth between business and another person. So exchange of money or money's worth between business and another person is the transaction. So the other person may be proprietor or some other person or institution. Next, 14th concept is account. An account is a classified statement relating to an item. An account is a classified statement relating to an item. The item may be a person, an asset, a liability, an expense, or an income, etc. The amount of an item gives the summary of all transactions relating to that particular item. So account is a classified statement relating to an item. Okay, classified statement relating to an item. So it gives the summary of all transactions relating to that particular item. Please subscribe to Way to Commerce. Thank you.